Hey, welcome back to The Dive. Today on the show, we have Todd Bubba Horowitz back. But before we bring him on, I'm just going to quickly remind you to tap on that subscribe button. Hey, Bubba, welcome back to The Dive.
It's great. Always great to be with you, Cassandra. It's a pleasure, and I always enjoy our conversation.
Yeah, it's so nice to have you back. Okay, so let's start with the jobs report. July's strong jobs report puts the Fed on track to slow its bond purchases. Do you think the substantial progress that the Fed is looking for aligns with investors' expectations?
Well, I think so far as you can see, the equity markets continue to run higher. I don't know that they align with what they should be, but when you're able to borrow money at a lower rate and reinvest it into a higher yielding stock market, I think for the very wealthy, it's been a great arbitrage. I think that what we really have here is a much bigger mess because as the Fed continues to be stubborn about what real inflation is, we get into these issues of how high can inflation go. And I think that's really the bigger story because when you forced every investor into one asset class, which is the United States stock market, eventually that will cause a pretty big problem.
Mm-hmm. And inflation appears to be really affecting the market. What impact is this having on your trading strategy?
We trade price action, and I don't really, whatever the news is, it doesn't matter. I'm not anticipating the news. I'm going to react to it. And, when you get into markets that are trending, okay, which many are right now, for example, the indexes are trending higher, and we've been long for quite a while. The only times it makes trading tough for individual traders is when markets go into a consolidation phase. And if you look at something like a copper or some of those products, they're consolidating it's much tougher and harder to make money. But when you get a trend, either up or down, that's when you make money in these markets. So I don't really adjust to the news. I have a method that works in all market conditions once they break out of either to the downside or to the upside.
And some are arguing that we're currently in a period of transitory inflation. Do you agree with that at all?
No, I look, the Fed went from transitory to temporary. And, Jackson Hole is in a couple of weeks. And I'm going to bet that if the markets stay strong, that they're going to float the idea of tapering faster than originally planned and to see what the market reacts. I think that the Fed is so far gone and they have never once made the right decision, just like not even recognizing how bad inflation is. I mean, wages are going to the sky. Crude oil, which doesn't count in inflation, but crude oil is double what it was less than a year ago. The cost of commodities has gone dramatically higher, but the Fed keeps saying it's temporary it started with transitory, then temporary. This is full-on inflation, and it could only get worse, especially if they continue this ridiculous stimulus package that we're running right now.
Now, high inflation combined with poor growth is puzzling, and many investors believe it is unreliable. Do you see any signs that markets are flagging and pricing in some form of stagflation?
I do. And I think that this is going to be the real concern. This is where the backwards thinking of stimulus plays out. You've got companies that can't hire and they're paying ridiculous salaries and hourly rates. You've got McDonald's paying $16 or $17 an hour, which is well above the minimum wage, and they still can't get help. So what'll happen at some point, business will slow and the demand for labor will not be there, and neither will the stimulus unless this government gets their wish of universal income, which would be a disaster. But this is, I think, the direction and the target that they're heading, which will be a much bigger failure than you could ever imagine, because you're going to see the very real possibility of a stagflation market back to the 70s with Jimmy Carter.
Mm-hmm. Okay, so let's shift to precious metals. Gold has dropped to its lowest level since March. A combination of technical variables and a lack of liquidity caused the flash crash. Do you believe the recent price activity indicates that the lows could now be in?
I thought on Sunday night Monday was the big flash crash. Now, again, I'm going to say that I believe that was more of a forced liquidation that created the bigger sell-off than it was actually a flash crash, because of what happens in these thin markets. Remember, It's August. Europe is basically closed. There's nobody really trading these markets. So you had a big someone that forced out. The markets started to tank, and of course, then they hit all the stops. If gold would have got back to positive on Monday, which it almost did, I would have thought we might have seen the bottom. But we have been short gold for a little while here, and will remain there because it looks like it wants to go lower. Even when you look at the rally, the recent attempts to rally, they've been rather weak and failing. And silver is still extremely weak. So this is the problem that I can see here. Now, eventually they're going to go higher. I mean, I'm a big fan of physical metals and owning them. But I think in the short term here, you got to be very careful and invest what you can afford, not to, because you're not going to be able to sell it so fast. I think there's still some more room to go on the downside.
Yeah, you're right about silver. The price has dropped to its lowest point in 6 months. Do you believe that this price action will result in a significantly larger downward move? And what factors do you believe have influenced its present price movement?
Well, I think silver's been very weak for quite a while, but I think when we look at it from an interesting side of it, the range until the other day was only $6 over the last 12 months. In the previous 12 months, the range was $18. So we've really been in a market that's been very tight and in consolidation versus a market that's actually moving. We finally have really actually broken out to the downside, which could take us, look, I don't like to make major, critical projections, but I could certainly see 22 or 21 and potentially lower. But, I look at it one level at a time where I would expect. And so far, we've been short for quite a while. And I expect to see the selling continue. And right now, 23.50, I could see, 22.50, 22 without a problem. Now, again, at some point it'll bottom, but right now it looks like it wants to keep working lower.
So you cited in one of your recent Bubba trading articles that you no longer trade platinum due to lack of liquidity as an investor. What needs to happen for the price chart to lag up?
Well, I think platinum, interestingly enough, as we've been talking today, I think platinum has actually potentially found the bottom. And let's be clear, I'm a big fan of platinum from a physical side, but when you want to trade it, the liquidity is not there. So I don't trade it actively, but I do buy actively physical platinum. But I think when you saw the crash Monday, I think you saw the bottoms potentially put in because platinum actually came all the way back and closed higher on the day. And it's currently speaking, it's over 1,000 again. And I do believe that right now on the board, the best value is platinum based on prices of everything else.
All right, interesting. Okay, well, thank you so much for joining us and giving us your thoughts again today, Bubba.
Thank you so much. It's always great to be with you.
That's it for today, but we'll be back again tomorrow, so be sure to hit that notification bell.